people that watches the news and gets all of your information from social media or from influencers. You're probably really confused about buy to let mortgages, especially after the Renters Reform Act. Make sure that you watch this entire video because I'm going to be talking through the impact of the new Renters Reform after May 1st, 2026. I'll also be giving you hints and tips and answering your questions about getting a property as a buy to let, either as a portfolio landlord or as someone who's just considering getting up and running. The truth of the matter. Okay, so the truth of the matter is getting a buy to let property is not a silver bullet. Investing in property is not necessarily easy, but it's one of those things that if you do it right, it can be very rewarding. So you just want to make sure that you're speaking to the right people, that you're getting the right information, and that you're also making sure that you weigh up all of the costs of getting a right to buy or a buy to let or any type of investment property. My name is Anthony Lindsay, and I've been in finance for over 30 years. I do these long form videos that I can explain and unpack questions that I get asked almost every day. I'm not an online influencer. I'm a qualified mortgage broker with decades of experience, and I'm someone that you can actually speak to. So what I do find is quite often people are getting their information from social media. As I always say, don't get your medical advice, your legal advice, or your financial advice from some guy on TikTok or some woman on TikTok. Because the fact of the matter is that your property may be repossessed if you don't keep up the repayments on your mortgage. So, what we're going to be looking at is some key changes to the buy to let landscape. So, now there are more tenant rights. So, if you're a tenant, that's great. But if you're considering getting an investment property to rent out to people, you need to understand the new landscape and everything that has changed and things that might be changing. One of the things to keep in mind, there's way more paperwork. So if you're the type of person that's just looking for something that's a kind of get rich quick type of thing or something that you don't need to put much energy into, then property investing is probably not going to be the best thing for you. A lot of people are led to believe that property investing is just like that silver bullet. They're going to make millions of pounds in a very short amount of time. Usually the people that are pushing that message forward are people that are selling a course or people that profit from you making mistakes. So the best thing that you can do is, before you consider investing in property, weigh the cost. Think about the expenses and think about what you're actually trying to accomplish. Are you looking for short-term gains, or are you actually looking to build legacy for your family? Are you willing to do the work that is required to make property investing profitable for you? Now that we have the renters reform, what you will find is there's a lot more regulation, there's a lot more paperwork, and there's a lot more of the renters' rights. So you want to understand and make sure you have the right tenants. There's also a higher barrier to entry. So what that means is 15, 20 years ago, it was a lot easier to get a buy to let property, put someone in there, kind of sit back and just watch the money come in. It's no longer the case. So you want to make sure that you're thinking through the entire process. So let's just break down a couple of changes or key changes to the buy to let market and things that you're going to want to consider with the UK Renters' Right Bill. This impacts landlords, so it's important to understand the changes and consider the changes before you proceed. The impact on landlords. So there's stricter eviction grounds. So what this means is that eviction must be based on specific legal grounds. And it's going to be a lot harder to evict people if you have a tenant in there that's not paying the rent, or a tenant in there that has antisocial behavior. It's going to be a lot more difficult to get rid of them. For the most part, the two grounds or the two reasons why you would be able to get your property back would be: one, if you are moving in. So if you're moving into the property, you would be able to get your property back or be able to get the tenant out. The other key reason or way you'd be able to get a tenant out is if you are selling the property. But everybody knows that you will have some landlords who might try to abuse this. So it's not something that can be abused. The burden of proof will be on you. So if you were legitimately planning on selling the property, then you will be able to get your property back. Or, as I said, if you or a family member plan on moving in. Other than that, it's really going to be up to the tenant to move out when they are ready to move out. They will need to give 2 months' notice, but it's a lot more difficult now to get a tenant out. So if you're a portfolio landlord or considering getting a buy to let mortgage, you need to consider that. What used to happen is a lot of people would just go in a chat group or go on Chat GPT more recently and just can I get a tenancy agreement? And just use these templates to be able to get a tenancy agreement, give that tenancy agreement to the tenant, and they think they're fine. You don't want to do that anymore. With the new renters reform and with the new buy to let mortgage requirements, you're going to want to make sure that you have the right documents in place. Don't download something offline. Don't ask a friend who's a portfolio landlord to send you theirs. Make sure you have a solid agreement in place that it complies with the new renters reform guidelines. If you're not sure, make sure you seek this out from a professional. If you contact me, I know some great professionals who I can get you in contact with that will ensure that you have the right documents in place. Because without the right documents, you put yourself at risk of fines, and you also put yourself at risk of having a tenant who can take advantage of the changes in the law. Another impact is mandatory registration. So landlords must register themselves and their properties on a national online database. This means added administrative responsibilities and requirements. So if you're the type of person that doesn't like reading, that doesn't like filling out forms, that doesn't like being compliant, and you're just looking for a quick win, then it's not going to be for you. And when you're going for your buy to let mortgage, a lot of these new documents will be required as part of the process. Or if you're a portfolio landlord and you have an existing property and what you're looking to do is remortgage, you're going to need to make sure that you have the relevant documents as of May 1st, 2026. So an old AST will no longer be acceptable during the mortgage process. Minimum property standards. And I'm going to major on this for a while because there are new minimum property standards. So all properties must meet the decent home standard. This may require upgrades to meet health and safety criteria. And this is around damp and mold and heating. I don't subscribe to the myth that you have these slumlords. So you have landlords who are just trying to get someone into a place and not take care of it. Most landlords are responsible and most landlords do their very best to keep the property up to spec. But with these new minimum standards, it means that if you have an older property, it may cost tens of thousands of pounds to get it up to that minimum requirement. So it's not that you are intentionally trying to avoid upgrading, but some of these upgrades are going to be very expensive. So if you are currently on the market to buy a new property, or you are currently a portfolio landlord and you're looking for a buy to let mortgage, you're going to need to consider the renovations or the changes that might need to be made in order to meet the regulations. Because if you don't meet the regulations, either as a newer person looking for a buy to let mortgage, maybe you don't get the mortgage, or if you're a current buy to let property owner or portfolio landlord, upon that remortgage, it may create some barriers. And if you don't do these things and then the tenant complains, you may be responsible for paying fines. So you're not going to be able to save money. You're not going to be able to cut corners. I will be explaining the step-by-step process of getting a buy-to-let mortgage in this new era. But what I first want to do is just point out some of the key things that you need to consider before you decide that you want to be a portfolio landlord or get a buy-to-let mortgage. Another key impact is the new ombudsman and stronger tenant rights. A new ombudsman will handle tenant complaints. Tenants will have more avenues to challenge landlords, increasing scrutiny and accountability. So again, there's lots more things that the renter or the tenant has on their side. And you, as the landlord, you, as the investor, the person that's put the money in, you have fewer rights and far more administrative responsibilities. Another thing to consider is the fact that many people right now who are looking for properties, or people who are looking to rent, they understand the new renters reform. So they're in a strong position when it comes to being able to challenge what you're doing. So make sure you understand the guidelines. So let's now just look at buy to let mortgages, what's required, what you need to consider about a buy to let mortgage, and I'll be answering your questions. I'll be right back. Make sure you watch until the end, because these are the questions that I get asked pretty much every day about buy to let mortgages. Okay, so if you're considering getting a buy to let mortgage, the good news is this: you don't necessarily have to even have a job. With a buy to let mortgage, the affordability is based on the rental income. So if you're getting a buy to let mortgage, and let's just say you don't have a job or you don't have a sufficient income, don't worry. The key thing with a buy to let mortgage is the rental income. Now, that's the good news. Now, a little bit of what you might consider the bad news to be is the fact that if you are getting a buy to let mortgage, then you need to usually pay down about 25%. So, a buy to let mortgage is a mortgage that is designed for somebody else to live in. Now, people try to cut corners and people do things that will get them in a lot of trouble. So if you have a residential mortgage, usually the deposit requirements are going to be a lot lower. So you may be able to pay down 5% or 10%. However, they're going to look at your income to figure out if you can afford that property. The difference with a buy to let mortgage and a residential mortgage is, with the buy to let mortgage, you don't even have to have an income, as long as the rental income is about 1.5 times the mortgage usually you'll find. So a buy to let mortgage is a mortgage that is designed to be used where someone else is living in the property other than the purchaser. Is an interest only mortgage a good idea? Now, what is an interest only mortgage and why does that make sense? Why would someone get a mortgage that they're only paying the interest on? So let me explain what an interest only mortgage is. An interest only mortgage is a mortgage where you're never paying down the amount that you borrowed. So you may have purchased a property for 300,000. Every time you make your payment, you're only paying the interest on that mortgage. So if you got a 300,000 pound mortgage over 20 years and paid every month, in 20 years you'd still owe 300,000. Most people don't do interest only mortgages for residential property, but they do interest only mortgages for a buy to let. And here's why. If you purchase a buy to let property and you're paying only the interest, you're still making money. And here's how. When you get your rent payment, so let's just say your mortgage is £500 a month, your rent payment is £1,500 a month. That means you're making about £1,000 per month. And let's ignore the maintenance fees, etc. for now. So for each month that you have that property, that is, it's rented out, you're making £1,000. So in a year, in theory, you've made £12,000. If you multiply that over the term of 20 years, then you've made that money in your pocket. £300,000 property, 20 years from now, you still owe £300,000. However, over the course of that time, you've made money. Plus, the property should appreciate in value. That means it should go up in value. So you've made money each month / each year. Plus, 20 years from now, when you go to refinance or if you decide to sell, you'll probably be able to sell it for more than you owe. So you'd probably be able to sell it for more than that 300,000 that you owe. So yes, an interest only mortgage is a good idea if you've thought it through and the numbers stack up and if it's a buy to let property. Do you need a special mortgage for investing? So, yes, you need a buy to let mortgage or you need a commercial mortgage. So, you cannot purchase a property as a residential property and intentionally rent it out. So, what I mean is, if you know you're not going to be living in it, which is one of the questions on the mortgage application, if you know you're not going to be living in the property and then you purchase it and then rent it out, you could be violating the terms of that mortgage. Now, let's just say you purchased a property, you're living in it, and your circumstances change. You get a job somewhere else and you need or want to move. You can get what's called a consent to let. So, a consent to let is a permission that a lender will give you to rent out your residential property. A consent to let will allow you to rent out your residential property, but there are some caveats. The lender will want to see in many cases that the place where you are now going to be living is a certain distance from that residential property. Some lenders will want to see that you've established residence somewhere else for 3, 4, 5 months. So you have utility bills, you've changed your bank account to that new address. Why? Because they don't want people doing a backdoor buy to let. So people who have purchased a residential property with the intention of renting it out, that is mortgage fraud, and that is not something that you want to get involved with. So getting a buy to let property is a good idea, but it is a special mortgage. It's not a residential. And can you rent to family and friends? This is a question that I get asked all the time. And as with most things that are finance and property related, it's not a pure yes or no. So if you have a buy to let property or you're trying to get a buy to let mortgage, one of the things on the application will be, do you plan on renting to friends or family? Mostly family. Now, this causes problems. And the reason why renting to family causes problems is because the lender knows if I'm renting a property to, let's just say, my sister, and she falls behind on her bills and on her rent payment, the likelihood of me taking her to court is a lot lower than if it was someone that was just renting the property. So you can rent to family. However, you would need to disclose that in advance and it could cause problems. So some lenders will just not do the mortgage. Other lenders may assess the affordability based on residential criteria. So, meaning, would you be able to maintain your household for your residential property and this buy to let property? The reason why they do that is because it's higher risk if you are renting to a family member than if you're renting to a regular person, just a random person that has applied for the mortgage. And this is even more important now that the renters reform has come into force because just the average renter has more rights than prior to May 1st, 2026. Residential versus buy to let, the deposit size. As I said, if you're getting a residential mortgage, usually the deposit is going to be much lower than a buy to let. Most buy to let mortgages will require a deposit of around 25%. You do have some that you can get away with 20%, and some, very few, that you can get 15%. However, in most cases, you're going to need a 25% deposit in order to get a buy to let mortgage. The use of the property, you can't be renting out to someone who's running a business from there. And this is the question that gets asked all the time, and this is very popular right now, is should I buy my buy-to-let property in a company name or in a personal name? And the answer is it depends. It's always going to depend on your long-term goals and what you're looking to do. And as a reminder, I'm not giving financial advice, legal advice, or tax advice. I'm simply explaining how products work, and your home could be repossessed if you don't keep up the repayments on your mortgage. But as far as buying through a limited company or in personal name, my quick rule of thumb is if you're buying a buy to let property and you know that you're not going to be buying any additional buy to let properties, it may be worth just buying it in personal name. If you know you're looking to build a portfolio, you're going to be buying multiple properties, then it might be worth considering buying it through a limited company or what they call a SPV, special purpose vehicle. So there's no yes, there's no no, there's no one size fits all. What you need to consider if you're considering getting a buy to let mortgage, you want to speak to an accountant, have that accountant tell you what they think based on what your long-term goals are. So always be open, be honest, be realistic. So if you know realistically you'd like to have 5 properties at some point in the future, but it's probably not going to happen, then maybe it might be worth just buying it through your personal name. However, if you know and you have an aggressive plan to build a property portfolio, it might be worth considering getting it through a limited company, but you'd need to speak to an accountant about that. And personal income versus rental income. One of the things that you're going to want to look at before you purchase the home is what is the rental income. So, because a buy to let mortgage is dependent on the rental income, you need to make sure that the property that you're purchasing has a rental income that can cover the mortgage plus about another 50% of that mortgage. So, lenders do something called stress testing. Lenders want to know that when that property is rented out, not only is the mortgage being paid, but there's an additional amount of income to cover maintenance and all of the different regulations that have come in place. So, what you want to do is probably speak to an estate agent. The estate agent should be able to tell you what the rental market in that area looks like. Find out what the rental market and what the rental income can be for that particular property. And then when you speak to your mortgage broker, as you're looking for products, he'll be able to find you a mortgage that fits that multiple based on that rental income. So it's very important that you do your research. It's also very important that you have a plan. Property investing is not easy, it's not for everybody. And even more so now, you need to make sure that you've thought things through and you're prepared. So interest only versus repayment mortgages, we now understand that a interest only mortgage is a mortgage where you're only paying the interest each month, which means the amount that you owe never goes down. The criteria will depend on age, what they call the repayment vehicle. So when you're applying for the buy to let mortgage, one of the questions that you'll be asked is what is the repayment vehicle? Meaning at the end of that term, because you're only paying the interest, at the end of the term, the long term, not the fixed period, at the end of that term, how are you going to pay off that 200 or 300,000 pound? In most cases, the repayment vehicle is selling the property. So you've purchased the property, 300,000, you've had it for 20 years. They're going to ask, well, how are you going to repay that off? How are you going to pay that off? In most cases, it is to sell the property. But as I said earlier, the great thing about it is if you've had that property for 20 years and it was 300,000 when you bought it, it might be worth 450. It may have even doubled in price depending on where you bought the property. The term is how long you would be making the payments, but keep in mind there's two key figures that you're looking at. The overall term, that's usually the bigger number, that might be 20, 30, 35 years, but also the fixed term. I always advise my clients not to get fixated on the big number, the overall term, simply because very rarely, very, very rarely does someone take out a mortgage for 20, 25 years and never remortgage. So remortgaging is when you hit the end of that fixed period, 2, 3, 5, 7, 10 years, whatever that fixed period was. At that point, the lender and the broker are going to reach out to you and say, your fixed period has now come to an end. What do you want to do? So the reason why you don't want to get too tied into or fixated on the long term is because let's just say you did a 20-year term and a 2-year fixed. At the end of that 2 years, when you remortgage, you don't have to remortgage over the remaining 18 years. You could remortgage over a shorter term, a longer term, depending on your circumstances. So the thing that you want to focus in on is the monthly payments and the fixed period, because after the fixed period, you're going to remortgage. The question that I get asked all the time is this the best rate? Now, we should be concerned about rate because you don't want to pay a higher rate than you have to. But every broker has a fiduciary responsibility to get you the best rate that you qualify for. So when it comes to product fees, this is the thing to remember. The cheapest rates, so you might find a rate starting with a low number like a 2, the cheapest rates usually have the highest product fee. So you might see a set of options as far as mortgages that you can get. One of them, the interest rate starts with a 2. That product fee might be 10, 15, 20,000 pounds. And the product fee is the amount that you pay just to get the product. So if you have a low rate, quite often when it comes to buy to let properties, you have a really high product fee. So the question of is this the best rate isn't usually the best question because you may have another product where the rate starts with, a 3 or a 4 or maybe a 5, but the product fee might be 2, 3,000 pounds. And the reason why that's important is if you pay a huge product fee, let's just say 10,000 pounds, most people aren't going to pay it out of their pocket. Most people will usually add it to the loan, which means you've borrowed 200,000 or 300,000, plus you've borrowed an additional 10,000. Unless you're doing a really long fixed term, it's probably not going to pay off in the long run. So I would say when you're speaking to your mortgage broker, don't just fixate on the rate. Have a conversation about the product fees because that's where they get you. The lowest rates usually have the highest product fees. And now we're going to look at the right mortgage type. If you're going to be buying through limited company, so you're not buying in your personal name, before you get up and running, if you're starting a new SPV or a new limited company, always speak to an accountant and a broker. So a broker is one discipline, an accountant is a different discipline because lenders will be looking for certain SIC codes, so SIC codes. Those SIC codes determine what kind of business it is. So some people get confused when we're talking about limited company. So you might have someone that's an accountant and they have a limited company and they're looking to purchase a property through that limited company. That's not what lenders want to see. Lenders are usually looking for SIC or SIC codes that are related to property. So as you're setting up your limited company or your SPV, speak to an accountant, tell them what the purpose of the limited company is, and make sure you also in tandem speak to a mortgage broker that they can tell you what SIC codes are required for the particular type of mortgage you're getting. The good news is if you've set the company up wrong and have the wrong SIC codes but have never used it, some lenders will allow you to add or remove the right or wrong SIC codes. But make sure you have the conversation. We talked about limited versus personal. And a big thing, a really big topic right now is HMOs and supported living. And I know a lot of people reach out to me asking me about getting a mortgage for a HMO, house of multiple occupancy, or supported living, or service living, things of that nature. Hold up. Don't just jump in and try to buy a property. What you want to do is make sure, especially if you're doing supported living, you have the appropriate background in the industry, that you have ties to the local council, that you're going to be able to get clients. Getting the mortgage kind of comes behind all of those things. I understand that in the process, part of the application process and part of the vetting is to see if you have the property. Getting the property is usually a little bit easier than getting those relationships going with your local authority and understanding what the needs in your local authority are. Because once you understand what the needs are, how many placements you're going to be getting, and what criteria, what the contracts look like, what the void period is, how they're going to place you, what needs those individuals have. Once you have that, you can find an appropriate and suitable property. Getting the mortgage is the easy part. finding the property, making sure that you qualify with your local council, making sure that you have the right relationships and the right experience. That's actually the hard part. What I find is a lot of people put the cart in front of the horse, so to speak. So they come and like, I need to get a property in order to get these contracts or in order to build this relationship with the local council. You're probably not going to be able to get a mortgage right out the gate if this is just something that you've seen people in your community doing. Everybody's telling you how much money they're making, and you've decided you're just going to hop on. It's not an easy thing. It's a very fulfilling thing, and it does a great community service, but you need to be ready to do the work. Property investing is not for everybody, and it's not an easy thing to do. Additional costs. This is the other part. Keep in mind, 50% of all mortgages fall through. So about half of them never complete. And there's a range of reasons why they don't complete. Sometimes people have put offers in on multiple properties. Sometimes the seller pulls out. Sometimes the lender pulls out. There's various reasons why these things don't complete. However, I would say one of the main reasons why mortgage deals do not complete is because people haven't weighed up the costs. People have seen a YouTube video or a TikTok video. They've said, yes, I want to be a property investor. They haven't looked at the full process, the cost, all the administration that's required, all of the paperwork that's required. So I would strongly advise you to speak to a mortgage broker that's not going to just sell you pie in the sky and tell you yes, 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 yes. You do want to work with someone that's going to challenge your knowledge. Now, you might say, well, I'm paying my mortgage broker. Why are they challenging anything? Well, a good mortgage broker sometimes will protect you from yourself. I've been in this industry for over 30 years. I've done debt collections, I've done lending, I've done lots of different things. And quite often, when things go wrong, it's one of two reasons. Either A, the person intentionally got themselves in that situation, or the person ended up in that situation. So if you have a mortgage broker that's going to ask you some questions, challenge your understanding, and make sure you're doing the right thing, that's going to be useful. And one of the ways that your mortgage broker can challenge what you're thinking is talk through fees. So stamp duty. If you're buying in personal name, and this is an additional property, there's a higher stamp duty that you will pay for a second home. Now, it's easy to estimate that. You can go on the government website and there's a stamp duty calculator. You just put that, it says second home. Solicitors, keep in mind, you do need to pay your solicitor. Your solicitor's fees will range depending on the type of property, the complexity of the deal, but you want to get a feel for the cost before you get moving. So what I usually do with my clients on the first conversation, I get a feel for what the deal might look like, and I produce a quote for them that they can do their math in advance and see if this is worth it. Broker fees. Now, I am a professional, and as with any professional, you're not just paying for the outcome, you're paying for the support. So broker fees may vary. If you're going directly to your bank, then your bank isn't going to charge you a broker fee, but you lose out on a lot of the support, a lot of the flexibility, and more importantly, if you go directly to your bank can only talk to you about their products. So a broker is going to be able to talk you through the range of products, show you a side-by-side comparison, tweak things, and especially if you have maybe some credit issues or you're a first-time buyer, first-time landlord, meaning you don't have a residential property and you're buying a buy-to-let property, you're probably going to need to speak to a broker. I would say everyone should speak to a broker. However, if you're buying a buy-to-let property, especially after the renters reform, you should certainly speak to a mortgage broker, someone who specializes and understands buy-to-let properties. So make sure that you speak to the right broker and make sure that you understand that their fees are for time, expertise, and sometimes protecting you from yourself. As I said, product fees. You will pay for the mortgage. So a buy-to-let mortgage the product fee might be $2,000, $3,000. As I said, the lower the product fee, then if you have a really low product fee, then more likely than not, the interest rate is going to be higher. The higher the product fee, then the interest rate is going to be lower. The other thing to consider is valuation. So this is where the lender goes out and says, Mr. Smith is buying this buy to let property for 300,000. How much do we think it's worth? So evaluation. Surveys. So evaluation and a survey are two different things. Evaluation is the lender assessing how much they think the property is worth. So that's the valuation. The valuation is for the lender. The survey is something that you can decide to do. The survey is for you. You pay for the survey. The survey is going to give you more information about that property. If you're getting a buy to let property, I would recommend getting a survey, because then you can understand if you may be purchasing something that's going to end up costing you a lot of money, especially because of the renters reforms and the new minimum property standards. You should certainly consider getting a survey, understand what the EPC rating is, understand what the room for improvement is, and make sure you're speaking to a property expert and an estate agent that's going to be able to support you with completing the right documents. And don't just say, well, I'm paying an estate agent, therefore it's their responsibility. As with every industry, you have people that will do the bare minimum. We've recently had people in government who have, been paying an estate agent, and the estate agent either didn't do the thing or gave them bad advice. Who knows? But either way, it's your responsibility. You can't be a property investor and be lazy. It's a lot of work. It's a lot of paperwork. It's a lot of administration, and it can be profitable and you can make money, but you need to be willing to do the work, and you cannot outsource everything. Yes, you will pay a broker who will give you information. You'll speak to an accountant. You'll have an estate agent, but you need to make sure you understand. Don't cut corners. Don't use ChatGPT to formulate documents. Don't figure it's somebody else's responsibility. It is fully your responsibility. So I have covered off a few things. So remember, if you're a portfolio landlord and you have properties after May 1st, 2026, make sure that you've gone on the government website and you've served the correct documents, you have the right type of tenancies, and you're within the law. If you're considering becoming a portfolio landlord, yes, the barrier to entry is a lot higher. It maybe is more complicated than it was. And maybe, just maybe, it's not as profitable as it was. But it's definitely something that you could consider. It's a great way of building legacy. It's a great way of building wealth if you're willing to do the work. If you don't want to do the work, then maybe property investing is not for you. There's lots of ways that you can generate money and build generational wealth. Property is one of those things that is viewed as quite sexy, but there's lots of more low risk ways that you can make money. So my name is Anthony Lindsay, and if you are looking for a mortgage, whether it be commercial, buy to let, bridging, residential, or if you just want to speak to somebody that's not going to charge you for the conversation, that is going to give you objective advice and guidance, make sure you give me a call. If you've watched any part of this video, please make sure that you subscribe to the station. I don't do just 30-second TikTok videos. What I try to do is break down and explain topics, answer questions, because I get a lot of questions during the week. My information is on the screen and you can reach out to me. You can book a free mortgage capacity report. This is where I will go through your individual circumstances and give you personalized advice. These videos are not designed to replace speaking to a trusted, honest, licensed mortgage broker. These videos are more to help explain parts of the process, explain the pros and cons of various things, that when you do speak to a professional, you can feel a little bit more confident. I'm not here to give legal advice, tax advice, or financial advice. I am a licensed broker who would love to speak to you, and I do these videos that you can share with family and friends. So please take the time to subscribe, take the time to like, and if you have any questions, or if there's something that you'd like to see me cover in a video, please make sure that you reach out and put that in the comments. By putting a comment, it lets YouTube know that what I'm providing is of interest to you. And by subscribing, it means that you'll be notified when I make new videos. If you scan the QR code, you can book an appointment with me or you can call me. One of the great things about working with a broker is most brokers have way more flexible hours than if you go directly to your bank. So I do have evening appointments, and on most weekends, I do Saturday appointments. And as you know, I do these videos. So please like, share, and subscribe. And I appreciate everyone that's watched. Make sure you share it with a friend or family.